Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up our interview with Mark J. Kohler, tax attorney for over 25 years, registered CPA and author. Faso, what's a takeaway or two that you had?
Well, I will say, to be honest, he makes some great content.
He does.
He's got some great books. Like one book was what your CPA isn't telling you.
Mm-hmm.
Which again, that title just caught my eye, but he's got some great resources. He started off the podcast on the wrong foot in my eyes.
How's that?
Dude, he gave you a compliment like right off the beginning. He's like, Cameron, man, you are looking sharp today.
He caught me off guard, man. I was actually caught up. I was trying to think of a comeback, and I couldn't. I stumbled in there, but
you're not used to getting compliments on the podcast. Well, yeah, I get it.
Well, I think it was more of a backhanded compliment, but yeah, whatever.
Oh,
yeah.
What? But
yeah,
man, he dropped some good wisdom. I gave him a hypothetical. Okay, let's say if somebody wants to buy a cabin more for personal use, is there a way that they can put a business spin on it? And take advantage of the tax depreciation in those first couple of years. You need to listen to it where he explained his answer, but I will say I'm looking for a cabin. Okay, that's all I'm going to tell you. But he does a good job explaining it. But I think overall, him explaining that, and in addition to the other wisdom that he dropped, it just reinforces the value of having a good CPA on your side who understands the tax code.
Yeah, great interview. Two takeaways that I had.
Cameron, I was just going to ask you, what are your takeaways?
Yeah, thanks for throwing it over this way. But two things that he brought up. One of them was self-rent. Yeah. I hadn't quite heard that terminology before. He gave a great example. And so I'm going to let him explain it in the video. But then the other thing that he touched on, again, that I won't finish for you guys is going to be cost segregation. Is we've had somebody come on talk about the benefits of it, but he did give us some insight on maybe some of the downsides, or at least how to proceed with cost segregation. So really good information, ton of value. But again, guys, we just listened to Mark Kohler. He's not just another CPA. He's a wealth building, tax slashing, business scaling expert who's been helping American entrepreneurs succeed for over 30 years. And his Main Street Business podcast, Tax and Legal 360 events, social media platforms, and Main Street professional certification programs help take the complexity out of taxes, enabling thousands of people to keep more money, grow faster, and build lasting wealth. Guys, hope you enjoy this interview with Mark J. Kohler.
Enjoy the episode.
Take care. If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad, along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today we've got our good friend Mark J. Kohler here. Mark, welcome to the show.
Hey, thanks for having me, guys. You look great. Your hair, by the way, Cameron, looks fantastic today. I just want to point that out.
Right out of the gates, huh, Mark? Nice. Man, not holding back. I like it.
What? I didn't know. Is there something going on with that? I just was pointing out you look good.
He does look good. I ain't gonna lie.
You're right. I do look good. Mark, before we got started, you were talking about taxes, and you called it fun, and you called it kind of a labor of love. I don't think that most people would refer to taxes with that kind of regard. I think that most people kind of approach taxes with maybe some fear or some angst. What would you say to somebody that's listening to this conversation and is thinking, man, here we go, another tax conversation. Why should someone listen to this podcast?
Well, let's get back to fun. I'm shooting for the brass ring here. And let me say why, everybody. Taxes are going to be your number one cost in life. 1 year it might be something else or another, but in the long run, at the end of the day, taxes are going to be your number one cost. And how many of you just love saving money? Like going to the store. I mean, many of us have done that, late night, Black Friday, after Thanksgiving, load up the car, go get a killer deal on a TV set. Who knows? We go to the mall and we're like, look how much money I saved. And we're doing girl math and we're just like, oh my gosh, the more I spend, the more I save, right? But when we're saving money, it's fun. It's exciting. And if we just need to change the way we look at taxes and realize that when we're talking about it, we're taking action. We're making a difference in our bottom line. It is so much easier to save money than make money. And with that mindset, now we're like, okay, show me what are we talking about? We're talking about saving freaking money. And if I may, I just want to say, this wasn't last thing I said earlier. I'm not long-winded, but just on this point, if you go hang out at a dinner party with rich people, wealthy people, you want to go hang out with billionaires and millionaires, do you know what they love to talk about? Saving taxes. You get around the bar and you're talking, they're like, oh man, I got this cool new tax strategy. That's what they talk about because they know how impactful it is and fun it is.
Awesome. Mark, we've got, you're talking about saving strategies. We've got a lot of our clients are real estate investors or want to be real estate investors. What advice do you have for somebody that is out there in order to save some taxes?
Okay, so what are some good tax strategies for the real estate investor?
Yes, thank you. Sorry.
No.
Thank you, Mark.
You're like, we got a lot of real estate investors out there. Hey, by the way, you got anything that saves taxes? Oh, okay. For real estate investors or for hair salon owners, I've got some great stuff. But for real estate investors, okay, all right, okay. For real estate investors, there are multiple ways to save taxes. You've got to find out which lane you're in. There's a different lane for short-term rentals than there is for long-term rentals. There's a different lane for self-rentals versus syndications. And then the rehabbers, the fix and flippers, if you will, put those in a bucket. Then you've got wholesalers. And then you've got hard money lenders. See, all of those are in the real estate investment community, but each one is going to have a different tax strategy for their methodology for the way they work in real estate. And it doesn't make one strategy better than the other, and it doesn't make one investment strategy better than the other. You just need to know what lane you're in, and then let's exploit the tax strategies that go with that. And that, so I give a 2-day workshop on this. I mean, literally, not, some are like, oh, a 2-day workshop on saving taxes. Yeah, just in real estate. I mean, just in real estate, there's so many options. So we've got to, so that's what I tell people is there's a saving strategy for you based on your real estate investment strategy. It's just matching them up.
What are some, that's great because their taxes are very different, passive or active. And then there's some depreciation rules. I would say a lot of our clients are more in the long-term rental area. What are some strategies that you found very helpful for people in the long-term space?
You bet. And so if your clients are in the long-term rental strategy, then if they're trying to save taxes, I would presume that they themselves or their spouse may qualify as a real estate professional. Mm-hmm. If not, then they're not going to see as much in immediate tax savings. We're going to build tax-free wealth in the long run, maybe through a retirement account. We can build tax-deferred wealth and then exit with 1031s and charitable remainder trusts. But if you're saying a lot of our followers are in the long-term rental strategy, mm-hmm. I would say if you want to save taxes the next year, you need to get out of that lane. If you want to save taxes in the long run, then wonderful, you're in the right lane. And I do both. I have long-term rentals, I have short-term rentals, I have self-rentals. I'm deploying my money in different real estate in different strategic ways, in different types of real estate to get different benefits. So, but to answer your question, if you're in the long-term rental lane, what we're going to be looking at is you or your spouse becoming a real estate professional if that behooves you, and we're going to be looking at putting long-term rental real estate in our retirement accounts. And that's going to give us the biggest bang for our buck if I'm in the long-term rental lane.
You had mentioned self-rental. I haven't heard that term before. You mind explaining that
my
for
gosh.
Cameron? Yeah.
This is gonna be a huge day for you. This is really good. So a self-rental is just what it sounds like. You're renting property to yourself. And when would I do that? When I have a business and I'm paying rent to someone else. I'm not talking about renting your own home to yourself, people, and be careful of the freaking Augusta strategy. Can we just say that now? And we're never going to just rent our home to ourselves. That's stupid. We're moving money from one pocket to another. What I'm talking about is I've got a commercial location where I'm paying rent to someone else. I'm a dentist, a doctor, an engineer. I'm a restaurant owner. I've got a storefront. I have retail. I have manufacturing. I have shipping or what. If you have a warehouse that you're paying rent to someone else, who's going to be your best renter? Yourself. Let's get out and acquire real estate where you already know you got a tenant. You already got a great tenant, a tenant you know that's not going to default on you, and it's yourself. So instead of paying rent to someone else, I can pay it to myself. And when you go there, we unlock SBA lending in a huge way, which I love, the 504s and other types of SBA loans. So you're now getting into commercial real estate with a built-in renter, your own business. And number two, you don't have to qualify as a real estate professional. You don't have to have material participation like a short-term rental. I just unlocked depreciation, holds bar, no holds bar, 100% depreciation opportunity, depending on how much of that depreciation is going to be deductible. We already know Donald Trump this year has said, I want retroactive 100% bonus depreciation. Love it. Well, if I've got a self-rental, I just unlocked that. I don't have to be a real estate pro. I don't have to have material under 7 tests. So self-rentals are super powerful for my clients that already have commercial space they're renting from someone else.
Love it. You just mentioned Donald Trump and some of the policies or platforms that he's been running on. Are there any provisions that he's suggesting or proposing that will directly impact small business owners?
Imagine if you could grow your wealth, access your money anytime tax-free, and never break the compound interest curve while you use your own money. Well, that's exactly what the infinite banking concept does.
And we help investors just like you implement this strategy, and we'd love to show you how. Schedule a free call with us and start taking control of your financial future today.
The link to schedule that will be in the show notes.
Yes. The first would be the bonus depreciation concept, which was passed back on the first round of the Tax Cuts and Jobs Act. Number two, he wants to extend the 199A or pass-through deduction for the S corporations. Powerful, love it. I mean, you can use it at the sole prop level, but if you're using it there, you got other problems. But the 199A QBI deduction he wants to bring back, which will be fantastic. We're going to see opportunity zones come back into play. The tax rates going down across the board for all Americans rather than going up, which they're set to do. I'm not, as a business owner, I mean, it's nice. No tax on tips, no tax on overtime, no tax on Social Security. There's going to be boundaries in those 3 strategies, but that doesn't impact me as a small business owner. I want the 199A. I want bonus depreciation. I want lower rates. And those are going to be the 3 major strategies that we're going to see in our next round of legislation. Now, American-made, local manufacturing. We might see cryptocurrency that's U.S.-based get a benefit. There's going to be some. So indirectly, business owners might have other strategies they benefit from, but those are probably the big ones.
Now, you'd mentioned him making it retroactive, the bonus depreciation. Well, Mark, first of all, can you explain to Cameron what bonus depreciation is?
An idiot.
Yes, of course. So for those out there that are not familiar with this, if you buy a normal rental property, and if you said a lot of your folks are long-term rental property owners, that's great. So am I. Then you're going to take the land value off of that building. So I buy a $400,000 building. Let's say I peel off 25% for land. So now I've got $100,000 on the books of land and $300,000 worth of building. The normal depreciation schedule would be 27 and a half years. So right out of the gate, I could start taking depreciation every year on that 300,000, essentially divided by 27 and a half. I know you accountants out there, there's a double declining balance in first year and half year and all that. I get it, but we're just saying 27 and a half years. But then, is the building really going to last 27 and a half years? Well, maybe the foundation and the framing and structural, but is the roof, is the internal utilities, the fence, the landscaping features of a sprinkler system and carpet and lighting and all. So anyway, what we can do is divide that building into pieces and parts through a special study called the segregation, cost segregation. And then we can depreciate the pieces and parts in a shorter time frame. So some property might be 5 years, 7 year, 15 year, yada, yada. Okay, so where's that bring us? Well, back in the first round of the Tax Cuts and Jobs Act, the Trump administration and Congress got together and said, let's fast track some of those asset classes that have a shorter useful life. So 5 years, 7, 15. We're going to allow you to bonus it, depreciate it, all in one shot. Boom, right now, 100%. And so it incentivized real estate investors that could benefit from that. Most long-term rental investors don't, unless they're a real estate professional or their spouse. That's why I like the self-rental and short-term rental for bonus depreciation. Any of you out there in long-term rentals, be careful of the cost sales pitch. But anyway, if I can depreciate it faster, then I can get better write-offs, put more money in my pocket, go buy more rentals, and I can build my portfolio faster. So bonus depreciation is that concept. Now, it was 100% for about 4 or 5 years, and then it went down to 80, went down to 60. This year, it's down to 40%. So I can't write off all of that shorter life property for 100%. I can only write off 40% of it right now in this year. Then it goes back into the pool over the 27 and a half years. So anyway, some of you that maybe sound like gobbledygook, but that's the sexy, fun stuff that you get to talk about at dinner parties with rich people and talk about bonus depreciation. You'll be a hit, trust me. I mean, everybody's going to gather around you by the water cooler at work too. But anyway, so that bonus depreciation, we'd love it to be back to 100%. And Donald Trump has alluded to that in several of his speeches, that if we can get the new legislation to pencil out, that's a whole other conversation, it's got to pencil out, but a retroactive benefit of depreciation this year would just be phenomenal. And then we can accelerate all that depreciation this year and save some big taxes. We'll see. Cross your fingers.
When he makes it retroactive, is that to January 1, 2025?
That's what we would hope. I think he mentioned one of his speeches, January 21st or 22nd. I can't remember the rationale with that. There was a good reason at the time, but it would be early of this year. That's what we would hope for.
Mark, you mentioned a concern with cost seg. Do you mind expanding on that?
Well, so if you're a listener here and you have long-term rentals and a day job, God bless you. Good move. Keep doing it. Don't stop. You're building tax deferred wealth and you're not paying taxes on that cash flow. Love it. But all that depreciation you're getting is going into a carry forward bucket, right? You've probably bemoaned this. You've been frustrated by this. You talk to your accountant. And unless you're a real estate professional, you can't unlock those losses moving forward. You have to wait until you sell the property. But you're going to get all those write-offs. It's delayed gratification. Be patient. Some people are like, yeah, I was going to write off my kids on my rental, but I don't get the write-off. No. You'll get the write-off. It's just going to come later. So continue to stack those write-offs up in your carry forward bucket. Well, what that long-term rental owner would want is to accelerate all that depreciation, right? Like we just talked about with bonus. I want to get all that depreciation right now. Well, if I go out, in order to do that, I got to do a cost seg analysis. I might spend $500 to $3,500 to go spend for this analysis. Well, if I spend for the analysis, the cost seg, and have on paper all this depreciation, but I can't take it because I don't qualify, I'm not able to take it, then what the hell? I just paid for this study and it didn't do me any good. But no one talks about that when they're selling the cost seg. They just say, do it, it's going to be great, but they don't know your tax return. So you want to make sure, this is why everybody listening here, you're doing the right thing listening to this conversation, because you can't pay an accountant enough to worry about your tax return 365, 724. You know, you got to know it yourself. You got to captain your own damn ship. So you should know your tax return and whether or not you would qualify for that pass-through depreciation. If you don't, then don't go do a cost seg. If you do, then you say, okay, what's the impact going to be? Do I have enough income? And that offset would save me taxes. Yes. Okay. Now we're at step 3. Let's go get the cost seg. So we don't want to rush out the door to go do that.
I tell you, Mark, I'm going to take this opportunity to ask you more of a hypothetical question.
Sure.
Let's just say somebody wanted to buy a cabin or a second home. Okay. Let's say that, but if they were to buy it as a rental, there could be some, and let's say that they qualify as a real estate professional, or they have enough passive income to offset that loss. If they were to buy that home, maybe rent it, maybe it'd have to be a short-term rental, but there's some rental in that year, but not much. But then so they take all of that depreciation in the year that they bought it. And then let's say year 2 or year 3, they say, you know what? I don't want this cabin to be a rental anymore. I'm not going to rent it anymore. It's just going to be a second home. Obviously going forward, there's no more depreciation. But to me, it sounds like it could be an opportunity for them to get some tax deductions, at least up front. And I know they have to recapture that depreciation in the future. But I just had this idea, but I wasn't wondering how correct my thought process may be.
You bet. Bless your heart. Whenever you hear someone say "bless your heart," you buckle up.
I know.
Toughen up.
That's why I'm asking. I want to know.
No. Let me say, the way you're onto something here, and I'll unpack it in maybe a more
articulate way.
Or articulate, or I wasn't going to say that, but since you said it, a little more organized way. I was expecting this question from Cameron, but Anthony, you stumbled through it. I'm proud of you. This is good. Okay. All right.
Nice.
Here's what you're saying. And you made some unique assumptions there. But let's unpack this. You said, let's say I want to go buy that cabin, and I'm a real estate professional, and then you threw out, or I might benefit from the tax write-offs or something. There was an or in there somewhere. Let's go through this. If I'm a real estate professional, and I want to go buy a cabin and get some pass-through write-offs, we're gonna get over there in a moment. Then I don't need to think about doing a short-term rental, because if I'm a real estate professional, any rental property I buy, commercial, rental, long-term, short-term, storage unit, if I truly qualify as a real estate professional, game on. Any rental property I buy and show that it was for the intent of rental, and I have rental income, I have now unlocked depreciation. Okay. Now, whether I do a cost seg study, how much depreciation I get, will it benefit my, I have clients that are real estate professionals, and all they have is tax-free cash flow. They don't have any day job income, or they don't have any S corp income, so the depreciation doesn't serve them. So we've got to have these stars align. Where in this example, I was a real estate professional, I've got ordinary income, or my spouse does. I want to offset the two. I'm off to the races. And then you throw out cabin. And I can see where you're going. a lot of people would have that dream. I'm going to get this cabin, get some kick-ass write-offs, and then 3 years from now, go up there and go fishing and sit by the lake and not having it be a rental. Is that a possibility without getting in trouble with the IRS? Yes, it is a possibility. So let me frame it in a way that I see much more common and a little easier to tackle. Let's forget real estate professional. A lot of your listeners and followers, as mine are, they're Main Street business owners. The percentage of real estate professionals is actually quite narrow. You've got the 750-hour requirement. It's got to be your primary occupation. You've got to put in a certain amount of hours in that material participation. Not a lot of people qualify. Let's be real. So, but what is wide open in this example? And here it is. I go find a cool cabin up in a resort area where there's a lot of opportunity for a short-term rental scenario, Airbnb, VRBO. I go up and buy that cabin, and I put in 100 hours through the summer and fall. Very manageable. I'm going to go up and work on this thing for 3 to 4 months with my family. I'm going to put in 100 hours and more time than anyone else. I can't hire a contractor that puts in 120 hours. I can't hire a landscaper, a cleaner, or someone that puts in more time than me. I have to do 100 hours or more and more hours than anyone else. If I meet that test, I'm now meet material participation. Check the box. Okay, so I find my cabin. I'm going to put in my 100 plus hours. And then third, I'm going to rent it at least 3 times before the end of the year as a short-term rental with an average stay of less than 7 days. I have now created a short-term rental for the year of 2025 with material participation, and I could depreciate, oh my gosh, hundreds of thousands of dollars of write-offs, depending on this retroactive allocation from the Trump administration, we hope. And I should say Congress. Trump is just pushing it along through Congress. So that's where I'd want to go. I don't care about real estate professional. Then next year, I maintain. Now, by the way, I'm going to have to fully furnish it. We've all stated in Airbnb, it's going to have to be fully furnished, which is cool. I'm going to have to put the money in for that. And I then go make cash flow year 2. So next year, I keep it in the Airbnb pool. Use that cash flow to pay for the furniture, pay for the maintenance and repairs that I put into it in 2025. It still qualifies as a short-term rental. I harvest any remaining depreciation that I can eke out of it, probably several $100,000 worth, depending on the cost of a cabin that qualifies as an Airbnb. I'm going to suspect it's going to be $400,000 north. Then in year 26, I changed my mind. I don't want it to be a long-term rental. I don't want it to be a short-term rental. I'm just going to shut that offer off. Okay. Because you had the intent to make it a rental and keep it as a rental, in the real estate realm, you do not have to recapture that depreciation or reclassify it as a personal second home. Only upon the sale do you have to recapture all that depreciation. So now you could keep it as a rental for the next 10 years, and you harvested all those write-offs in year 1 and 2 and didn't even have to be a real estate professional. So Anthony, your idea is fantastic. It's just putting it in the right sequence and then pulling this baby off. Now, the best strategy in there would be at the end is just to die. Because when you die, your family's going to get stepped up basis, and no one pays tax on the fair market value, and all the depreciation recapture is gone. I talked to my client. A lot of them don't like that strategy. They don't like dying in the mix. It's part of it.
So, Mark, what I'm hearing is that it is possible.
Yep.
However, we need to follow we need to check a couple of boxes to make sure that this is kosher with the IRS.
And I've seen clients do this over and over again. Over and over again. I've got 3 properties in the mix like this right now. Very common. Just have a good tax advisor. And if you folks listening don't have a good tax advisor, we'll give you a link here at the end to a network of advisors that speak Mark Kohler.
Okay. Well, I tell you, you know what, I was kind of a little hesitant to ask more of a personal question, but this is some of the beauty of the podcast.
I thought it was hypothetical.
It is hypothetical, but it's one of my goals for 2025. But also, I got to imagine this could be a strategy that some of our listeners could be using. And I think one point of this, Mark, that you brought out is that we can use a tax code to our advantage. If you're working with an advisor who knows their stuff, understands the tax law, not running from it, but running to it, that there's ways that we can minimize our largest expense, which is taxes.
Absolutely. And just 100%. And I really, I'm passionate about it. It's actually, like I said at the very beginning of the show, fun when you realize you're legally and ethically working the system. You're just knowing the rules of the game. And folks, the code was set up for this. This isn't some loophole that we discovered that wasn't meant to be there. Why did the government allow for this? Why does the government allow for real estate professionals and self-rentals and bonus depreciation? Because it stimulates the economy. It builds infrastructure. It upgrades communities. And it creates zones of development. The government intentionally passed these laws hoping someone would pull their head out of their butt and go do it. But then there's people like, oh my gosh, you're abusing the system. What do you think they didn't intend us to do this? What are you, crazy? Go do what the government's asking you to do, and we will incentivize you. Go down and rebuild the Katrina damaged hurricane areas. Go rebuild a nationally declared disaster area. Go rebuild. This is how the government, who sucks at rebuilding, gets things done. They give real people, real investors, real business owners tax incentives to go do what they can't do. And then you think it. And then someone might say it's unethical. Oh my gosh, freaking A.
Mark, I like seeing you fired up.
I see you going, and I'm going to throw something out there. Anthony had a hypothetical. I had a question that is kind of a what if, but this idea of tariffs has been floated by President Trump as well. It's kind of a complicated topic. I haven't seen a whole lot of information out there on it. Do you have any idea how this thing is going to play out and what this looks like moving forward?
Well, I have it right here. I have the answer. Let me pull out my crystal ball. And I brought it here just for you guys. Yep.
Love it.
Okay. Yep. Here we go. I got the answer.
This is what I was hoping for.
I appreciate that.
Perfect.
Yeah. Let's call Mark. He's got the crystal ball. He will help us here.
So he tells me to buckle up, and he tells you he's getting the crystal ball.
Yeah. Well, that's because Cameron's question is a little more out there on the hypothetical. No,
it is.
Here's the thing. The tariffs generating revenue from imposing fair tariffs, where I think all of us are behind, Republican or Democrat. We're like, hey, if we're paying out the rear to go sell our product in your country, but we don't charge you the same tariff to come into our country, something's wrong. So we want a fair playing field. I think all of us, anybody that's gone to middle school or high school wants a fair playing field. Let's keep it fair. Reciprocal tariffs make sense. But the people that don't like this, that are, have anything that Trump does is wrong, no matter what it is, because prior Democratic presidents tried to fight the same tariff battle. He's just a master negotiator. But the point being is, it's not the message, it's the messenger that's got people riled up. But the message is something we all can get behind. Let's have reciprocal tariffs that are fair. And number two, the money we make from that as a government, we're taxing another business in another country. We're not taxing a country. We're taxing a business that wants to bring their product to the U.S. and do business here. The same thing they do to us. So if that business owner wants to come to the U.S. and sell their product, please come do it. You're just going to pay a tariff. And guess where that tariff money goes? Top of line for our federal budget. So now we can generate more tax write-offs and lower tax rates for us as Americans because we generated more income by not taxing us, but for taxing a business in another country. Well, sign me up. And so some might complain and go, well, that's going to drive up the cost of that product on the shelf because that business owner in the other country is going to pass that cost on to us. Okay, great. I'm going to buy a US made product then. Bye. So much data has already been shown that these companies don't pass that cost on because they want to stay competitive. They understand that market share is more important than price. So they keep the price the same to stay competitive on the shelf in the US. Or what happens? Us Americans wise up and buy American made or from another country that was willing to pay their tariff. So I think it's a wonderful thing. I think we're going to see lower tax rates for you and me. We're going to see more top line revenue come into the US budget, and we're going to have a fair playing field. It's just some people hate the messenger, not the message. It's classic.
Mark, thanks for entertaining our hypotheticals and educating us on these. I know you've got an event coming up in June. If some of our listeners are looking for more education, can you tell them about that event?
Oh, please, everyone, business owners, tax professionals, legal advisors, financial advisors. It's called our Tax and Legal 360. It's a 3-day event, 24 classes, main stage, motivational, basic business skills to high-end tax and legal strategies. We've got, I think, close to 20 instructors, continuing education certified for those that need it. And it's where everybody gets together and finds a better advisor, finds better clients, and we're all leveling up. As part of Main Street America and everything we're doing with the Main Street Business Podcast. And we'd love to have any of you there. It's an affordable price point. Just get to taxandlegal360.com. And if any of you are looking for a tax advisor, you can go to my network. We have the Tax Pro Network, over 1,000 tax advisors now that we've trained in our program, personally by me, and weekly trainings. It's affordable for the tax advisor to get certified. And for you, the business owner, you can go to that network, and I don't make any money on that relationship. You can do discovery calls and find a good advisor. Go to markjkohler.com. Go up into the services tab, or you'll see a tab there that says Tax Pro Network, and just start shopping. Young and old, male and female, West Coast, East Coast, down the street, not down the street. Find a tax advisor that speaks your language. And that language is a language of making money. And when you find that advisor that you can connect with, get them hired, get going.
Well, Mark, I think you made a great case of the value of working with a CPA who understands the business and understands the tax code. So we really appreciate you coming on, Mark. Is there any question we should have asked or anything you'd like to leave us with?
Well, yeah, I thought you were going to ask, where'd you get that crystal ball? I mean, they're pretty. I think they're at the aisle at Walgreens called what you see on TV. I don't know.
Yeah.
But anyway, you can find one.
That's fancy. That's fancy.
Good to know.
Mark, appreciate you joining us today. Thanks, man. We'll have to bring you back sometime soon.
All right. Thanks, guys.
All right, take care.
Go make a fantastic day.
If you like this video, I know you'll like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.